Hey guys, I'm Jacob. I'm the founder and CEO of Metrosuite, and you guys are listening to the Metrosuite podcast, where we talk with experts who are helping solve one of the biggest challenges in housing today, the missing middle. We dig into what's working, what's not, and how we can make housing more attainable, practical, and built for people, for how people actually live today. I'm super excited to introduce our guest today, which is Samantha Chan from Elevate Realty Partners. She is one of the leading voices on multiplex and missing middle housing and acquiring properties that work great for investors. Hi Samantha, how are you?
Hi, Jake. Thanks for having me.
Thanks so much for coming. I'm personally a huge fan. I love what you guys are doing over there, and we've built a little bit of a working relationship. Big shout out to Elevate. So I I, I I think one of the biggest topics that we are looking at, and really the investor community is seeing, is how missing middle and multiplexes and how to navigate the market and all that good stuff. But where I was hoping to take this first is just to learn a bit more about you and how you came to where you are. So maybe you could share a little bit about your personal
Yeah.
story.
Oh gosh. It's going to be completely not real estate investing related to begin with. So I did industrial engineering at the University of Toronto many years ago. And then I graduated, worked a year in engineering, and then afterwards, an opportunity came up in Hong Kong in the investment banking field. And so I took that on, moved to Hong Kong for 3 years, and I structured derivatives, like foreign exchange derivatives, in investment banking for 3 years. And then after that, I decided to take a 180 approach and moved back to Canada and decided to start my own business. And this also was not engineering or banking investment related. This was actually a social painting studio. I started in 2010 and owned it for until 2018. So for 9 years. And I grew it. So it started with one location, and then we expanded to Little Italy, Leslieville, and then we moved to downtown Markham. So we had multiple locations across the GTA. And it was just like a new social painting experience where people can just do other things instead of just going to the movies or going out for drinks or dinner and stuff like that. I would say during that era it took off, but then life changed, life happened, and I had kids. And so I was like, okay, I wanted the business to grow, but I wasn't the right person to grow the business, so I ended up selling the business. But the good thing about me during this whole process is I was actually a real estate investor the entire time. Even when during my iBanking days, because I was in the investment field, I really wanted to make good use of my money. So I started investing in condos first. And then once I opened up the business called Paint Lounge, started investing in houses. So my first house was actually a house hack. And I don't know if you know what that means, but basically you buy a house, you live in one unit, you rent out another unit just to help cover the cost. And back then it was really living rent free. I think in today's Toronto prices and today's rents, you can't exactly live rent free, even though you can live a lot um, for a lot less than if you were just to own the whole house outright or just to rent a place. But back then, yeah, you were able to live rent free, and then and then eventually my family grew and we outgrew the house hacking situation and we took up the whole entire house. And then, but it was really because of the house hacking situation where I was able to save up more money, accumulate more wealth more quickly so that I can move into the next property. So for me, actually, I like to buy one house a year. And it's been that way for quite a while. And yeah, so ever since, I mean, before houses were only able to be split into 2 units, some areas 3 units legally. But things have really changed in Toronto over the past 5 to 7 years, I would say. You're in the ADU space, so first thing was the laneway suites, right? That came about, and then afterwards, they started opening up to garden suites as well. And then before, I was saying you can only split a house into 2 units or maybe three, but now, well, not now, a couple of years ago, they're like, okay, every single house you can do 4 units plus the ADU, so that's 5 units. And then as of this year, you can do up to 6 units depending on where you are in the city, and then plus the ADU as well. So things have really improved, I guess, from the missing middle standpoint. And there's just a lot more options for real estate investors to grow in this space.
Okay, a lot to unpack there. That is super cool. So, to the extent that you're comfortable, tell us a bit more about living abroad and what it was like to be in investment banking. I myself am very interested in that sort of field, and you said derivatives, so that's super interesting.
Yeah. Well, okay. So it was kind of it was fresh is it was a position that was fresh out of school. So you're basically doing all of the grunt work. And there's a so you would wake up really early in the morning and try to catch the news from across Asia. So the first market to open would be Australia. So you need to wake up really early just to figure out what's happening in Australia, what's happening in Japan. And then I was in Hong Kong. So then the Hong Kong market opens. And at the same time, you're also trying to catch up on what happened overnight in the US and in Europe as well. And then just bring it all together, summarize everything. Before, we didn't have ChatGPT, so summarize everything for the team in the morning, so that at 8 a.m. You report everything to our trading floor team as a junior. And then afterwards at 9 o'clock, for example, we recap it in email form and we send it to our clients. For my team, we focused on corporate derivatives. So, for example, it wasn't for people just for purely investing. So, for example, if you were trading, like we were in Hong Kong, so a lot of businesses had to do foreign exchange transactions for business, and they're already exposed to business risk. And one thing that they do want to eliminate is foreign exchange risk. So, for example, if something happens to currency, it really changes up how their net profit is like, right? Depending on where the currency swings. So what our goal is for them is to make that currency, like hedge the currency risk. So basically eliminate, like no matter what happens to shifts in currency, they wouldn't get exposure to currency because they've locked in the rate. So that's basically what we did. We worked with corporations to help them kind of minimize this currency risk. And I was actually in the management associate program. So apparently they interviewed thousands of people, and I was one of like the 10 people that was chosen for that program. And what
Wow.
happens is you go to every single department in the bank to understand everything from like front office to back office, middle office, the legal department, everything, so that you understand, how the whole company works. And the goal for them is so that they'll eventually groom these people to be the future leaders of the company.
Right.
Some of the
So
people like in my group are still in the company, and they're very high up. And then on top of just rotating, this is all in the first year rotating, we were also sent to actual like in class training for half a year as well. I was placed in Shanghai, which is a city in China, and then all the different like management associates in the different cities across Asia. So we had Australia, India, Singapore, Malaysia, Philippines. I think that's it. Indonesia, maybe. They all kind of just joined. It was like basically a mini MBA program that very intensive. There's tests every single week, and then you need to make sure you pass all the tests, and then you graduate. And then, so I didn't actually get a formal MBA. But through this program, like they really just wanted you to understand every single thing that's needed for you to be a successful banker. So I guess that's where I got the investment knowledge there. And I also have my the trading securities license as well because I needed that for investment banking. So got all my bases covered there.
Yeah, it's really interesting. I mean, any of the videos. So I'm like a huge fan, like I said, of Elevate. I've watched a lot of your videos, and any of the any of the videos, or at least the recent ones, like the past 6 months that I've seen, they are so well done from a numbers perspective. Like all the pro formas are very precise. They're very backed by information. I think I have a hunch it's you that's behind those. Maybe not, but I wonder if it's sort of like that carryover from all that skill that you've built in that period of your life.
Yeah, I think that's pretty much it. Well, engineering, I was in industrial engineering, which is basically optimization, statistics and optimization. So very data focused, and investment banking definitely was. And people think like running your own business, like your art business, it's not, but you really, to grow the business, you have to analyze data to make sure like you know what to focus on next and how to grow the company. So I would say, yeah, it's a big part of me for sure. And
And
yes,
it's
it was me.
Yeah. Oh, it's you. Okay. Yeah, that's what I
Yeah.
figured. It's really interesting too. I mean, I feel like in that period of your life, you probably didn't look. You probably weren't like, "Oh, yeah, I'm doing this because it's gonna help me build the skills or like that muscle to like do what I'm doing right now, which is just like missing middle in Toronto." But it's just interesting looking back, like connecting the dots. Like, oh yeah, okay, like that makes sense that happened and helped me get to where I am. I don't know if that's like a fair comment or you feel that way a little bit.
Yeah, no, like I definitely didn't expect to do this. If even if you asked me like maybe 5, yeah, I started 6 years ago. So if you asked me 10 years ago, I could not imagine myself doing this. But I think all of those skills really equipped me to be so good at what I'm doing right now, which is on top of being a real estate investor, I'm helping investors invest smart with data numbers in the real estate space. Yeah.
Yeah, yeah, for sure, and that's a great segue into Elevate and what your role is there. So maybe just if you could just tell our listeners what Elevate is and what they do and what you're focusing on there right now.
Yeah, Elevate is, I mean, essentially, it's a real estate sales brokerage. We have a group of agents that help people buy and sell real estate, and that's how we make money. But I mean, I'm sure you know lots of real estate agents. Everyone knows lots of real estate agents. How we stand out is we focus specifically in the missing middle space in the 416. And I would say probably just even south of Eglinton and investment properties primarily. I would say 90% of our transactions are multiplexes, and then the extra 10% might be our clients who have purchased multiplexes from us who are looking to sell or buy their own end user home. They just enjoy working with us, and we continue to help them with that kind of that service as well. And then we pride ourselves and call ourselves an end-to-end sales brokerage. So we help figure out what the client needs strategy wise, and then for the deals, for the properties that we show them, we crunch all the numbers to make sure the investment makes sense, and then negotiate strategically to help them buy, and then onwards as well. So there is, the turnkey type of properties where you can rent out the property on day one, but a lot of investors who are in the space are actually looking for more. They're looking for a value add lift as well. So they're looking to take on renovations, hoping that their property would gain more than how much they put in. So a big part of what our agents work does is to figure out for this kind of property put it into like highest and best use, like what kind of renovations are needed to get that done, and then prepare like once you buy a property with us, we'll prepare a detailed scope of work for you to show you, like, okay, this is like the renovations you need and how much approximately it will cost. And then we do have a network of contractors and architects, design people that we can connect you to make it all happen. In terms of the actual renovations, project management, we don't currently have the resources on our team. That would be on you, or you can hire. We have contractors who does project management, but that's on you. And then, but once the project is done, then you can pass the ball back to us, and we do have a leasing team that can help you rent it out, do the due diligence to make sure you put the right tenants in, and then we also have a property management team as well, so that you can focus on investing and not putting out fires like fixing toilets and stuff like that if you don't want to, because a lot of our clients they do have families and work a full-time job, and life does get busy. And then if even though managing a property might not be too much work, but if it is like enough work that it stopped them from investing in real estate, that's what we noticed before. We wanted to solve that problem. So initially we didn't actually have property management, but because that was kind of like a roadblock for people to invest further, we ended up just creating this property management arm of the business. And now I would say it's a good end-to-end service that we offer for real estate investors in Toronto.
Yeah. Yeah, and I mean I can personally attest to working with you personally and with Elevate. A client of ours was looking to purchase a property, and you guys were just amazing. Like everything was set up, opportunities were shared, and the pro formas were created, and it just made it so easy. I also find it really interesting how you guys like specialize on things that are pain points. Like this specialized finding of opportunities for investors, for them to take action and then sort of picking up after it's done, is I haven't seen it really in Toronto. So big kudos to you guys on that.
Yeah, I
Yeah.
think it's like for us, we're like, okay, this is what we would have wanted when we were investing in our first one or two investment properties. That didn't happen. So we wanted to solve this problem as engineers, obviously. And that's what we've created.
Are there other engineers on your team?
Yeah, so the owner of Elevate, Simon Law, he went to school with me. So we were in engineering together, and that's how we met. Yeah, so that's the other engineer on the team. The other people, I would say we're all real estate investors. We all own multiplexes on the company and in the company. Some of the other people, they have business backgrounds and related kind of backgrounds. But yeah, me and Simon.
Yeah, because I remember reading somewhere, or maybe you had shared with me, that you guys actually have your own multiplexes as well. Like you've done this for internally. So it's just interesting because it's not like you're giving advice to people based off what you've read or researched. Like you have lived experience as well. So I feel like that's
Yeah.
a big advantage.
Yeah. Right now we're doing, well, me personally, I'm working on three projects, three multiplex conversions. Like I would say on the sales team, we have six people, and on average, each person's working on two to three at the moment. So
Wow.
you can multiply that. Yeah. Very active personally in the space, and we really believe what we preach.
Yeah, yeah, for sure. So another area I wanted to ask you about, I saw your video on YouTube yesterday about the Toronto market, and rents are coming down, but prices are coming down and rates are coming down, and it's some of it's cyclical and it's a little bit confusing. Could you maybe talk to that for our listeners?
Yeah. So, okay. So normally when rents and prices are supposed to be inversely related, when prices come down, people are like, okay, I don't want to buy yet. And they move to the rental market. And that's why rents go up. And that's what happened when rates came up, right? So prices shot down 20% and then rents shot up. And then now that interest rates are coming down, prices should technically, with rates coming down, prices should technically go up, which hasn't happened, but rents have come down. So this is actually abnormal. I think rents coming down is actually normal, and right now it has stabilized. Prices coming like not coming back up, it's abnormal, but it might okay, so it might not be abnormal, but basically there's a delay. So we're in this like weird time where prices rents have come down already, but prices haven't come up yet. So it's kind of like an arbitrage opportunity. Where because prices are still low, interest rates have lowered, rents down, which is normal, but it has made cash flows look so much better compared to the past 5 years. Because cash flow, with like the inverse relationship, cash flow should more or less be like similar. But because of this abnormality, we have seen cash flows really shoot up. So, for example, for turnkey 3 unit rentals, normally you'd be lucky to break even, but these days, like we're seeing over $1,000 of positive cash flow in Toronto. People are like, I don't think Toronto cash flows. They're like, okay, maybe condos don't cash flow. Turnkey multiplexes normally break even, but no, today it is cash flowing very very, very well, over $1,000. And then if you take on a project, obviously you buy at a bigger discount. And then because of
Because
that,
why is it a bigger discount? Because it's a
when
knockdown
you're buying a project, well, so
or a
if
conversion.
something's already done up, you might like for example, in East York, you're buying a done up house for $1.3 million. So if it's something that's run down, you wouldn't expect to pay $1.3 million. These are selling for like $800,000 to $900,000 these days. So there's actually like a $400,000 gap between the two. And the reason why investors are buying these cheaper houses is because they know that they can put money, maybe 200 grand into the project. So you're like $1.1 million, but then if it's valued at 1.3, then you make an extra $200,000. And that's where the investment opportunity lies these days. And because the purchase price is much lower, your mortgage payments are much lower. And that's why your cash flows are much higher after that.
Can you explain the concept of why rents would be coming down when rates are coming down?
Yeah, I mean, so the rents come down because so basically the reason why rents usually come down is because there's less of a demand for the rental market. So when rates come down, more people flock to buying real estate again because they're like, oh, houses are becoming more affordable because borrowing rates are lower. And that's why with less demand in the rental market, that's why rents come down. But these days, there's also another reason. It's because of the condo supply. We're just seeing a lot of new condo supply coming onto the market, and with lower demand as well, it's just really pushed rents down quite a bit. So that's pretty normal. And the other reason why landlords are willing to take on lower rents is because their mortgage costs are lower too because of lower interest rates. So they don't need as high, they don't require as high of a rent to cover the mortgage costs as well.
When you say rents are coming down, like is it really the whole city, or is it like you kind of have to like create buckets like condos and then missing middle housing and then single family homes? Like is like new product, and I know there hasn't been that much yet, but is new product that's coming online, say like a 2 or 3 bedroom in like East York, is that rent down, or is that like what's that
Yeah.
renting at?
It is down. Like for example, if you're looking at a year and a half ago, we might be renting out a 2 bedroom above grade for $2,800 a month, and then now it's probably 15% lower, so $2,600 a month. So it really is across the board, but because the demand is a little bit stronger for the missing middle space, and then there's not as much supply, you do see, I would say, slightly, you don't, it hasn't come down as much as, for example, a condo, one bedroom unit, where I guess, rents were really high before, and now you're looking at like $2,200 a month for a one bedroom condo, maybe. I don't track condos as much, but like it might be closer to the 28 mark before, a year and a half ago, right? So it
Yeah.
has come down more for those kind of asset classes.
And so where do you think all this is going? Like where do you think first of all rental rates for missing middle product is going, and then also most importantly prices for candidate projects are going, and from your standpoint.
Yeah. Okay. So rents, I know in the video I said rents have come down, and that's because it's a year over year change. But I've been tracking rents, and ever since May, I would say prices have really stabilized. So
This year.
of this year, yeah.
Yeah.
So it hasn't really moved as much. So I think, if nothing shakes up the market, I don't foresee too much of a dip on the rent side. We are expect from the interest rate side, we are expecting, I'm not here to say it, but most big banks are projecting one more rate cut for this year. So there's going to be an announcement either in October or December. Given what the economic numbers are showing these days, probably not, the rate cut won't be in October, but in December. Affordability is going to improve slightly if people are going on variable rates. And then usually what happens is at the start of every single year, you have the optimism kicks in the real estate market. So, if you just draw out like real estate prices over time, ever since, for example, 2018, from January till the first half of Q1, Q2, January till June, you always see a pickup in prices. And then it kind of like levels off, or might like dip a little bit over the summer because people are away for vacation, or they're just enjoying their summer. They're not looking at real estate. And then the market kind of picks up again in the fall. And then it kind of dips again closer to the holidays, Christmas season. And then it goes up again. So I think this trend is going to continue, given that rates are going to come down a little bit. You still have the optimism. The stock market is actually not doing too terribly. It's actually all-time highs these
And
days. So people
TSX as
still
well.
have, they actually have the money to invest. It's just they're just trying to figure out what makes the most sense, right? So I still anticipate, it's not the real estate prices in Toronto. I can't say for Canada. It's really not going to shoot up. I don't like the fundamentals are not there, with weak growth, but I don't expect too much of a price dip from this point on. And I do, yeah, like starting the new year, you'd probably see a slight recovery because of the sentiments and the lower interest rates. But from like currently from this point until end of the year, it's a tricky spot. Like I think it is a very strong buyer's market. Confidence is not how it's been like, compared to pre-COVID or even during COVID. So there are lots of good opportunities these days. So yeah, like if you're looking for a buying opportunity from now until end of the year, it's definitely a good time to buy.
Yeah, no, thank you for all that. So, okay, I guess building on that, what would be, and not to get too specific into the details, like what would be the way to an investor could build wealth? Like, let's say that they buy a property with you guys. First of all, what type of property should they buy, and what would they do with that property, and then how would it look? Just very high level, if you could.
Yeah, I mean, it depends. The biggest thing is budget, right? Like everyone and that's the sandbox that we really need to figure out what is right for a specific investor. So
Right.
I'd say most people probably like who are looking for the missing middle space have maybe around like 300 to 50 $350,000 to invest in, and that really just narrows down their options. They can either buy these days, like I said, a turnkey 3-unit house that's ready to rent out on day one, and they just collect cash flow and long term, and then like wait for long-term appreciation. We usually like to look for houses that have a enough space in the backyard so that once they have more money, they can potentially build a garden suite or a laneway suite in the back too, just to bump up their rents as well and then bump up cash flows. And once that happens, they might when they purchase the property, they might be tight from like a mortgage standpoint. But once they start cash flowing better on this property with the garden suite or laneway suite, they can potentially qualify for another mortgage to buy their second property. So that's like one option. The second option for investors, if they want to grow more quickly, would be to take on the project. Buy a house that would be cheaper these days, maybe $800,000 even in Toronto. Yes, that's possible. And then you put in maybe 150K of renovations. You are looking at more or less a similar budget, 350, 400K of capital. But because you take on this project, you end up getting an extra value add lift. So you can go back more quickly to the bank to refinance and pull out equity. So these days you might be like, say you put in 400K, you can pull out 70% of that out. So close to $300,000 out. And then now you have cash to reinvest again. You might need to save up a little bit more, but maybe next year or the year after, you might have like 350, 400K again, and then you can get into your next property. So that this kind of strategy, we call it the BRRRR strategy.
And for
like
our listeners, can you just break that down, the BRRRR?
Yeah, buy, renovate, rent out, refinance, and then repeat. So you just kind of do this process, and then once you refinance and then you should be able to have enough equity in order to move more quickly into your next property, and that's how you grow your portfolio a lot faster.
And so where's the biggest opportunities for investors that want to take on like a more meaty project? So like knock down or conversion and build a 4-6plex, like where in the city? And maybe other cities. We've just been talking about Toronto. I don't know if you service like Hamilton and other areas like that.
Yeah. Well, I can only speak to Toronto because that's the area that we focus on. Meaty, I would say the best absolute lift would be the new builds because, but then you are looking at a lot more capital and a lot more time. So if you compare your return against time and capital, would I say it's worth it for most investors? Probably not. But if you are the right profile, like if you are a builder, then and you're used to taking on private money, you're used to taking on debt for a long period of time, and you have really good prices for construction, then these could make sense. You're looking at maybe $1 million in construction costs plus your purchase of the house. So maybe $2 million in costs, and your finished product might be worth $3.5 million. So you make $1.5 million from something like this, but it's huge risk and a lot of capital. So I would say for most investors, it's probably, unfortunately, not for you. The other good opportunity in this market that's more suitable for more mom and pop investors, I would say, would be like the more premium locations, actually. Like before prices dropped, for example, Trinity Bellwoods or the Annex, like houses there were selling for maybe like $2 million. Days you can pick them up, like our clients are picking them up for like 1.1 $1.2 million for some of the very distressed ones. And renovations, no matter where you are in the city, it costs the same, right? It really just depends on the builder and your contractor. So you can get a good price for the upgrades, and then there is quite a meaty spread these days. It's obviously not worth $2 million these days anymore. Maybe 1.6 to 1.8, depending on your finishes. But that spread really is still there. And yeah.
Yeah, and so you said like 1 million in lift, and that's how much money you're making. Do investors look at like what is the lift or the value I'd gain primarily when the project's finished, and then or is it more like the cash flow? or is it both?
Yeah, so that those are two completely different strategies. Like those who are focusing on cash flow, um, you don't really need to like if you're looking for a property with lift, like for example in Trinity Bellwoods, their cap rates or their rent yields are not necessarily that great compared to a cheaper neighborhood where you can buy in for a low price and then rents don't vary all that much. So if you are looking for cash flows, I wouldn't pick these like value add lift locations. I'd pick like a more rental grade area where you can get in for cheap and try to like do rental grade renovations and get it rented out as soon as possible, and then start collecting rents. You would get maximum cash flow that way. But if you are looking for a lift, I would focus on more premium neighborhoods, maybe nice, slightly nicer finishes, because valuations would be higher. But when you rent it out, just keep in mind like purchase prices or home prices do vary quite a bit, no, depending on neighborhood. But rents don't vary nearly as much. So you might be like looking at a 20% increase in rents in a nicer neighborhood, but your purchase price might be double, right? And that's why the rent yields don't make as much sense. Yeah. So
For all
it's
the
very strategy dependent.
Yeah, it sounds like it. It definitely sounds it. For all these questions, someone can reach out to you and you'll basically help them go through it. Is that right?
Yeah. So we're kind of like a coach, like on top of like a real estate brokerage. And the reason why we do it is because it's a long-term relationship. It's not, you don't just buy your house and then we say bye and we won't see you again for for 10 years. And then by the time you sell, you come back to us. Like our investors actually buy properties. If it works out, like if they do the burst strategy, they buy one every 2 years, every year, every 3 years or so. So it is definitely a long-term relationship and we want to keep it that way.
Awesome. Awesome. Yeah. I think we'll leave it there, but maybe you could just share how people can get in touch with you and how the process is from your side.
Yeah. So go to our website, elevatepartners.ca, and then from there, you can book a call. It's a free 30-minute call where we just chat. It's like no strings attached. And I try to get to know whoever's contacting us more and then try to give good recommendations. And then if you want to decide to work together, then we'll figure out next steps from that call.
Okay. Thanks so much, Samantha. Thank you for your time.
Yeah, thanks for having me. So yeah, I guess that's it.